Welcome back, everyone. Dr. Mark Dennis here once again. In this session, we're diving into chapters 5 and 6, where we'll look at why banks are regulated and how bank financial statements are constructed. These two areas go hand in hand. Regulation helps maintain trust in the banking system, while financial statements show how banks operate and manage risk. Our journey this week begins with Chapter 5, where we explore the question, why regulate banks? Regulations are essentially laws enacted by Congress, usually in reaction to some type of crisis or severe misconduct. Think about the financial crisis of 2008, Enron and Arthur Andersen's downfall, or perhaps the Wells Fargo scandal. Each of these events led to new regulations. The reason is simple. Banks handle an enormous amount of financial resources, and confidence in the system is vital for the overall economy. The basis for banking regulation is threefold. First, banks manage about 20% of the country's total financial resources, so their actions directly affect the economy. Second, trust in banks underpins the system. Without confidence, people would pull their money out and the economy would suffer. Third, we operate under a dual banking system here in the U.S., with both federal and state authorities sharing oversight responsibilities. Let's look at the principal regulators. The Federal Reserve supervises member banks, approves mergers, and oversees other activities. The Office of the Comptroller of the Currency, or OCC, is the oldest agency and charters national banks. The FDIC insures deposits, supervises most U.S. banks, and requires call reports. Finally, state banking organizations issue charters for state banks and provide oversight at the local level. Together, these agencies form a safety net of supervision. Banking regulations can be neatly grouped into categories. The first include landmark foundation laws like the National Currency and Bank Act, the Federal Reserve Act, and the Banking Act. Then we have social responsibility laws such as the Equal Credit Opportunity Act and the Community Reinvestment Act. Finally, transformational laws and international agreements reshaped the industry, often after major crisis events. The Regal-Neal Act allowed banks to expand across state lines, creating today's large, nationwide banking networks. Gramm-Leach-Bliley repealed parts of Glass-Steagall, letting banks offer securities and insurance, but also raising concerns about risk. The Patriot Act strengthened anti-money laundering requirements after 9/11, while Sarbanes-Oxley increased accountability for financial reporting after scandals like the one at Enron. Check 21 modernized the clearing system by allowing electronic checks. The Emergency Economic Stabilization Act created TARP under the 2008 crisis as a means of stabilizing banks. Finally, Dodd-Frank established the Consumer Financial Protection Bureau, or CFPB, and restricted risky bank activities through the Volcker Rule. On the global side, we have the Basel Accords, international agreements that set standards for capital and risk. Basel I in 1988 focused on minimum capital requirements and credit risk. Basel II in 2004 refined this by adding operational risk and better aligning capital with actual risk. Basel III in 2010 responded to the financial crisis by adding liquidity requirements, and tougher capital standards as a way to strengthen resilience. In short, these laws and agreements don't just tweak the system, they transformed how banks operate as well as how they are now supervised. Landmark Foundation Banking Laws. The National Currency and Bank Act of 1863 created the Office of the Comptroller of the Currency. This was the first major federal law impacting banks in the United States. It set up a system for chartering and supervising national banks, essentially the foundation for federal banking oversight. In 1913, the Federal Reserve Act created the Federal Reserve System, the central bank of the U.S. The goal was to stabilize financial markets, reduce panics, and bring order to the economy. Before this, the U.S. had gone through repeated financial crises with no strong central authority to step in. The Banking Act of 1933, also known as Glass-Steagall, created the FDIC, the Federal Deposit Insurance Corporation. It separated commercial and investment banking as a way to reduce risk and restore confidence. At the time, FDIC insurance covered just $2,500 in deposits. Today, that figure is $250,000. The point is the same. Depositors should feel their money is safe inside the banks. Social responsibility laws focus on fair treatment. For example, the Truth in Lending Act requires clear disclosures on loans and credit cards. The Equal Credit Opportunity Act prohibits discrimination in lending. The Community Reinvestment Act requires banks to serve low and moderate income communities fairly. Together, these laws ensure access and fairness in financial services. The Regal-Neal Interstate Banking and Branching Efficiency Act of 1994 was a turning point for U.S. banking. Before this law, banks were restricted by state boundaries. For example, a bank chartered in Georgia could not just open a branch in nearby Florida. This kept the industry fragmented into thousands of smaller, often regional banks. The act changed that. It allowed bank holding companies to acquire banks in any state and merge them into a single network. This is why today we see large nationwide banks like Bank of America, Wells Fargo, and J.P. Morgan Chase. Their nationwide presence is a direct result of this law. But the law also included safeguards to help prevent over-concentration. One rule was that no single holding company could control more than 30% of total deposits in any given state. That limit was designed to keep competition alive and prevent one bank from completely dominating a state's banking market. So in short, the Regal-Neal Act enabled the national-scale banking system that we have today while still placing some guardrails on market share. Transformational laws fundamentally changed the industry. Gramm-Leach-Bliley repealed parts of Glass-Steagall, allowing banks to expand into securities and insurance. The USA Patriot Act was passed in 2001, right after the September 11th terrorist attacks. Its purpose was to strengthen national security by giving financial institutions a bigger role in preventing terrorism financing and money laundering. The act created FINCEN, the Financial Crimes Enforcement Network, as a hub for gathering and analyzing financial intelligence. Banks became key players in this effort. Let's look at the main requirements. First, banks must report cash transactions over $10,000. This was designed to flag large, unusual movements of money. Second, every bank must have a dedicated BSA officer, someone responsible for compliance with the Bank Secrecy Act. Third, banks must file suspicious activity reports, or SARs, whenever they detect potentially suspicious transactions. These reports go directly to federal authorities. And finally, all bank employees must undergo annual training on anti-money laundering rules so they know what to look for and how to escalate concerns. This law significantly transformed how banks operate day to day. What used to be a purely financial business now involves compliance teams, transaction monitoring systems, and constant reporting to regulators. In short, the Patriot Act turned banks into the front line of defense against financial crime and terrorism financing. The Sarbanes-Oxley Act of 2002, otherwise known as SOX, was passed in response to massive corporate scandals at Enron, Arthur Andersen, and WorldCom. These cases exposed fraudulent accounting practices and a lack of accountability at the executive level. SOX created the Public Company Accounting Oversight Board, or PCAOB, to oversee auditors and ensure independence. It also requires CEOs and CFOs of public companies to personally certify the accuracy of financial statements, with steep penalties, including fines and even jail time, if they are found guilty of misleading investors. The law also restricts insider stock sales during blackout periods and demands more objective external audits. In short, SOX was designed to restore investor confidence by making corporate executives and auditors directly accountable for honest and transparent financial reporting. On the international side, the Basel Accords, Basels 1, 2, 3, and 4, set global standards for capital, liquidity, and risk. These agreements align U.S. rules with other major economies to ensure banks worldwide are resilient. For example, Basel III added stronger liquidity requirements after the global financial crisis. Bank examinations are another key tool. Regulators conduct annual safety and soundness exam using the CAMELS rating system: capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to risk. Scores range from 1, which is strong, to 5, or severely deficient. Examiners issue findings called MRAs, or matters requiring attention, and MRIAs, matters requiring immediate attention. These help keep the banks accountable. Next, we transition to Chapter 6, which looks at financial statements in the banking world. Bank financials differ somewhat from corporate statements because they focus on how the banks make their money. The primary statements are balance sheet, also known as report of condition, and the income statement, as well as disclosures of off-balance sheet obligations. These show how banks generate profits, fund their loans, and manage risk. The balance sheet is a snapshot at a single point in time. On the asset side, we see how the funds are used, things like loans and securities. On the liability side, we might see sources of funds such as deposits. And equity represents the owner's stake in the bank. The basic equation, of course, is that assets equal liabilities plus equity. Bank assets include cash and reserves, government securities, and loans. Loans are especially important because they are the primary income source for banks. Loans can be commercial, retail, or other types such as real estate. Banks also maintain an allowance for possible loan losses, a sort of cushion for loans that might default. Loans are the primary asset for banks and also their main source of income. Unlike a typical business that sells products or services, banks earn revenue mainly from the interest they charge on loans. There are two broad categories of loans: commercial loans, which go to businesses for things like expansion, working capital, or purchasing equipment. Retail loans, which are made to individuals, things like mortgages, car loans, or personal loans, are the other broad category. Now, when banks report loans on their balance sheet, they don't simply list the total amount that they have lent out. Instead, loans are recorded as net loans. This means, first we start with gross loans, the total outstanding. From this, we subtract the allowance for loan losses, which is essentially a reserve set aside to cover loans that may go bad. What's left is referred to as net loans, which better reflects the expected collectible amount. This allowance for loan losses is very important. It's a contra-asset account, meaning it reduces the value of total loans shown on the balance sheet. Banks use this to account for loans that may become non-performing, meaning the borrower has stopped making payments. So in short, while loans are the lifeblood of a bank, they also come with risk. Setting aside allowances helps protect the bank and gives investors, as well as regulators, a more realistic picture of the bank's financial health. Liabilities are mostly deposits. These include checking accounts, savings, time deposits like CDs, and interbank borrowings. Deposits are the core funding that banks rely on in order to make loans and investments. Within deposits, we distinguish core deposits, which are stable and reliable, from other types. Core deposits include savings accounts and checking accounts. Money market deposit accounts and smaller CDs also count as relatively stable. Banks value these because they provide a dependable base of funds. Equity represents the bank's ownership capital. This includes preferred stock, common stock, and retained earnings. Retained earnings are profits the bank reinvests rather than paying them out to investors in the form of dividends. Strong equity provides a cushion against unexpected losses. Finally, off-balance sheet items include things like credit commitments, derivatives, and standby letters of credit. These don't appear as traditional assets or liabilities, although they do still carry some risk. In fact, across the industry, the total notional value of off-balance sheet items exceeds on-balance sheet assets many times over. This makes monitoring them absolutely essential. That wraps up part 1 of the Week 2 live chat. We've covered why banks are regulated, some major banking laws, regulatory bodies, and the structure of bank financial statements. In our next session, we will go deeper into the income statement and some other performance measures. In the meantime, reach out if you have any questions about this week's content or assignments.